There's a number that should make you physically uncomfortable, and it's not the national debt. It's not the S&P's PE ratio. It's not even the price of a dozen eggs in 2026. The number is 1%. Sounds harmless, right? Almost cute. One little percent. The kind of number you round down and forget about. But here's the thing about 1%. Over a 40-year career, a 1% annual fee quietly eats somewhere between 25 and 30% of your total retirement savings. Not 1% of your savings. A quarter of your entire nest egg. Gone. Not because markets crashed. Not because you made bad bets. But because you didn't read a document nobody actually reads. And here's the gut punch. You agreed to it. You signed the paperwork. And somewhere in a glass office building, a fund manager is driving a Porsche Cayenne with your future. Welcome to the 401(a) industry, the most successfully marketed retirement scam in American history. And before you close this tab because you think you've already heard this, you haven't. Because this isn't the fees are bad video everyone's already seen. This is about why the system is built exactly this way on purpose, who designed it that way, and the mechanism that keeps it humming along no matter how badly it serves you. Let's start at the beginning, because the origin story matters. The 401(a) didn't start as a retirement savings vehicle. It started as a tax loophole for executives. In 1978, Congress passed the Revenue Act, and buried in Section 401(a) was a provision that allowed high-income employees to defer compensation into investment accounts, tax-free. That's it. That was the whole point. A footnote in a tax bill designed for people who already had money. Ted Benna, a benefits consultant, figured out in 1980 that the provision could be used to create employer-matched savings accounts for regular employees. He proposed it to the IRS. They approved it. And almost by accident, the 401(a) became the primary retirement vehicle for the American middle class. Notice what didn't happen. Nobody designed the 401(a) from the ground up with the goal of maximizing retirement outcomes for average workers. Nobody asked, what's the most efficient, low-cost, conflict-free structure we can build to help Americans retire with dignity? That question was never on the table. What was on the table was a tax loophole that got repurposed and handed to an industry that immediately figured out how to monetize it. And monetize it they did. Here's how it actually works. Your employer sets up a 401(a) plan. They hire a plan administrator to manage it, typically a big financial services company. That company curates a menu of mutual funds that employees can invest in. And here's where the incentives turn sideways. The plan administrator doesn't make money by picking the best funds for you. They make money from the funds themselves through something called revenue sharing, also known in the industry as 12b-1 fees. Basically, the funds pay the administrator to be on the menu, which means the funds that appear in your 401(a) aren't necessarily the best funds available. They're the funds that paid the most to be there. Think about that for a second. The restaurant where you're being forced to eat paid to put itself on the menu, and you never get to see the check. Now let's talk about the fees themselves, because this is where it gets almost artistic in its cruelty. The average 401(a) plan charges a total expense ratio somewhere between 0.5% and 2% annually. The national average sits around 1%. And again, 1% sounds fine. Until you do the math, here's a real example. Say you start contributing at 25. You put in $5,000 a year, your employer matches 3%, and you average a 7% annual return over 40 years. No fees. At 65, you retire with roughly $1.1 million. Standard compound growth. Textbook example. Now add in a 1% annual fee. Same contributions, same return, same 40 years. You retire with around $800,000. That 1% just cost you $300,000. $300,000 compounded over time, quietly drained out of your account every single year. While you were busy, living your life and not reading fund prospectuses. Now add a 1.5% fee, which is not uncommon for actively managed funds inside a 401(a). You're down to roughly $680,000. You've now handed over $420,000 to people who, statistically speaking, did not beat the market anyway. Because here's the part that makes it genuinely maddening. Active fund managers, the ones charging you extra to pick stocks on your behalf, underperform their benchmark index roughly 85 to 90% of the time over a 10 to 15-year period. That number comes from Standard & Poor's SPIVA report, which tracks this stuff religiously. And the longer the time period, the worse the numbers get. Over 20 years, it's closer to 95% of active funds underperforming a simple, boring index fund. So the product you're paying more for is worse than the free version. In what other industry does that happen and nobody gets arrested? Let me introduce you to someone. Call her Karen. Karen is 35. She's been contributing to her company 401A since she was 27, and she thinks she's doing everything right. She contributes enough to get the full employer match. She rebalances once a year. She picked the moderate growth fund because it sounded responsible. What Karen doesn't know is that her moderate growth fund has an expense ratio of 1.2%, buried on page 47 of a 112-page document she received during onboarding and immediately recycled. She also doesn't know that her plan's administrator charges an additional 0.4% in administrative fees. And she definitely doesn't know that her moderate growth fund has underperformed a basic S&P 500 index fund by an average of 1.8% annually for the last decade. Karen isn't a bad investor. Karen is an average investor inside a system that was never designed to optimize for Karen. Karen is the product. And to be clear, none of what Karen's plan is doing is illegal. That's the part that should keep you up at night. All of this is completely, totally, 100% legal. The conflicts of interest are disclosed in the same way the terms and conditions for a social media platform are disclosed. Technically transparent, practically invisible. Now here's the behavioral layer that makes this impossible to escape even if you do know about it. Most people don't pick their 401n funds actively. Studies show that the majority of plan participants just go with whatever the default option is when they sign up. And what's the default option in most plans? A target date fund, which sounds smart, balanced, and professional. And sometimes it is. But target date funds also carry average expense ratios of around 0.5 to 0.75%, which is still higher than the 0.03% you'd pay for a basic Vanguard or Fidelity index fund. Which means inertia, the basic human tendency to just accept the default setting, is worth hundreds of millions of dollars annually to the financial services industry. They didn't design the default to hurt you. They designed the default to monetize your indifference, and it works beautifully. Here's where it gets even more interesting, because the 401a industry didn't grow by accident. It grew because it replaced something: defined benefit pensions. The old system, where employers bore the investment risk and promised you a specific monthly check in retirement, largely died between 1980 and 2010. It got replaced by the 401a, which shifted all investment risk, all decision-making responsibility, and all fee exposure onto the employee. Corporations loved it because they removed a massive liability from their balance sheets. Financial services firms loved it because suddenly 60 million Americans were being herded into investment products they didn't fully understand. The average American worker went from being a passive beneficiary of a professionally managed pension to being the de facto portfolio manager of their own retirement account, with no training, no time, and no real ability to comparison shop the fees because the fee structure wasn't even standardized until 2012. Before that, many workers had literally no idea what they were paying. The 401 industry currently manages over $8 trillion in assets. $8 trillion. And it extracts roughly $80 to $120 billion in fees annually from that pool, depending on whose estimate you use. That's not a rounding error. That's a transfer of wealth from the American middle class to the financial services industry, every single year, one quiet percentage point at a time. So what can you actually do? Because this isn't just a misery tour. First, look up your plan's expense ratios right now, not later. Now, log into your 401na portal and find the fund details for whatever you're invested in. If the expense ratio is above 0.20%, ask yourself why you're not in an index fund. Second, if your plan offers a low-cost index fund, like an S&P 500 index fund with a sub 0.10% expense ratio, use it. The research is not ambiguous on this. Low-cost index funds beat the majority of active managers over any meaningful time horizon. Third, if your employer offers an HSA, it's arguably the most tax-efficient vehicle in the entire US tax code. Contributions are pre-tax, growth is tax-free, and withdrawals for medical expenses are tax-free. After 65, it functions like a traditional IRA. It is, objectively, a better deal than a high-fee 401a, and almost nobody maximizes it. Fourth, if you're self-employed, a SEP IRA or solo 401a gives you significantly more control over which funds you access and what you pay for them. Fifth, at minimum, always capture the full employer match before doing anything else. That's a 50 to 100% instant return on your contribution, depending on your plan terms. No fee in existence cancels that out. And sixth, if your 401a plan has genuinely terrible options, you are legally allowed to complain to your HR department and request better fund choices. Companies have a fiduciary obligation to offer reasonable plans. They don't always meet it, and nobody is going to remind you that you have standing to push back. So push back. Here's the uncomfortable truth at the center of all this. The 401a isn't a broken system. It's a system working exactly as designed, just not for you. It was designed by people with different interests than yours, optimized for different outcomes than yours, and maintained by an industry that makes more money the less you pay attention. And the most dangerous thing isn't the fees themselves. It's that 1% feels so small that most people never bother to look, which is exactly the point. So I want to hear where you land. Do you think the 401 system is A, fundamentally unfixable and the whole thing needs to be restructured? B, fine as long as people take the time to pick low-cost index funds? Or C, a deliberate extraction machine that the financial industry will never let anyone reform because there's too much money at stake? Drop your take in the comments, because that's where this gets interesting. And if you've discovered something genuinely infuriating inside your own retirement account, share it below. Because sometimes the most useful thing you can do is make sure the next person doesn't make the same mistake you did.